At some point, without a sound, without a warning, your money crosses a line. You still see the number. You still feel like it's yours. But legally, functionally, it isn't anymore. Most people never notice the moment it happens. They swipe, they tap, they log in, and the illusion holds until it doesn't, because modern money doesn't disappear when it's taken from you. It disappears when ownership quietly changes hands, and that invisible line matters more right now than almost any other rule in the financial system. Let me show you where it is. Imagine this. You work. You get paid. Your salary hits your bank account at that exact moment. You think, that's my money. But here's the uncomfortable truth. Legally, it's not. The second your paycheck lands in a bank, it stops being your property and becomes the bank's liability. That sounds abstract. So let's slow it down. When cash sits in your hand, it's yours. No middleman, no debate. When money sits in your bank account, it's not stored. It's borrowed. You didn't deposit money. You lent it. The bank now owes you a number, not a pile of cash, and that difference is everything. This wasn't always obvious. In fact, the system was designed so you wouldn't notice, because if people fully understood when ownership ends, behavior would change. Fast, banks don't take your money and put it in a vault with your name on it. They use it, they lend it out, they invest it, they leverage it, and they keep only a fraction on hand. That's not a conspiracy. That's the core design. This system works beautifully when trust holds. It breaks instantly when trust cracks. And right now, trust is thinner than it looks. Here's the part almost no one talks about. Your bank balance is not proof of possession. It's proof of a promise that depends on liquidity, regulation, timing, and confidence. Most days, that promise is honored without friction. On bad days, rules change. Let's talk about those rules. If a bank struggles, your account doesn't automatically mean access. Withdrawals can be limited. Transfers can be paused. Accounts can be frozen, not because you did anything wrong, but because the system prioritizes stability over individual ownership. That's the line. You cross at the moment. Convenience replaces custody, and here's where it gets strange. The more digital money becomes, the harder it is to tell where that line even exists. Tap to pay, auto deposit, one-click transfers, friction disappears. Awareness disappears with it. Money feels faster, lighter, safer, but structurally it's weaker because speed doesn't equal control. Now zoom out. Why does this matter right now? Because governments, banks, and markets are under stress at the same time. High debt, rising interest rates, fragile confidence. In these environments, systems don't fail loudly, they quietly rewrite priorities. In past crises, we've seen bail-ins instead of bailouts. Deposit guarantees stretched, redefined, delayed. Access managed instead of ownership respected. Not theft, not collapse, just limits. And here's the uncomfortable math. Banks cannot return all deposits at once. They are not designed to. That's not an accusation. It's arithmetic. Your money works only as long as most people don't ask for it back. That's the deal everyone implicitly agrees to until they don't. Now, contrast this with the hype. We're told money has never been safer, more regulated, more insured, and on paper, that's true, but insurance doesn't eliminate risk. It delays consequences. Coverage has caps. Claims take time. Systems prioritize order, not speed. In other words, protection exists, but access isn't guaranteed when everyone wants it. That's the reality gap. Now here's the ironic part. The system doesn't rely on deception. It relies on indifference. Most people don't care how money works as long as it works. So the line stays invisible, but once you see it, you can't unsee it. Cash feels bulky but final. Digital money feels sleek but conditional. Neither is perfect. Both have trade-offs. The danger isn't using banks. The danger is assuming custody when you only have permission. Zoom out one last time. This invisible line shapes power. Who controls liquidity decides who waits. Who waits absorbs the cost. Who moves first preserves value. That's why large institutions diversify custody. Why corporations spread deposits. Why wealthy individuals obsess over access, not yield. They're not chasing returns. They're managing lines. So here's the question to sit with. If your money technically stops being used the moment it enters the system, how much of your financial security is ownership and how much is trust you've never tested? Because the line isn't new, you just weren't supposed to notice it until now.